RSUs can quietly create tax problems, concentration risk, and expensive default decisions, all while looking completely fine on the surface. And I see smart, high-earning professionals fall into that trap over and over again. The shares vest, some get withheld for taxes, the rest land in the account. And because everything appears to work, they assume everything is working just fine. But underneath that, three things are happening at the same time. Your income is rising, your withholding may not be enough, and investment decisions are being made by default instead of on purpose. None of that feels urgent in the moment, which is exactly why it goes unaddressed. And these are not problems you can clean up later. They're happening in real time, every time your RSUs vest. I'm Daniel, a fee-only financial advisor and owner of Archstone Private Wealth. I help high-earning millennials in tech reduce equity comp tax surprises. Right now, I'm offering a free 60-minute equity review. Go to the link in the description below and book your free equity review. In this video, I'll show you what vesting really means, why so many high earners get blindsided by taxes, and the hidden decisions you make every time shares hit your account. Alright, let's start with the part that trips almost everyone up. Most people look at an RSU grant and think, great, I've got $100,000 in stock coming. And on paper, that sounds reasonable, but that number is not real, at least not yet. At grant, you don't own shares. You don't control the timing, you don't control the price, and you definitely don't control what those shares will be worth when they arrive. What you really have is a promise that if you stay with the company and meet the conditions, shares may be delivered over time at whatever the stock price happens to be when they vest. So instead of thinking about RSUs as stock you already have, think of them as a schedule of future income events at an unknown price. Here's an example. Let's say you're granted 1,000 RSUs when the company stock is $100. That looks like $100,000 on paper. But later, 250 shares vest when the stock is at $140. You didn't receive $25,000 of income, you received $35,000. That's what hit your tax return. And that number could have been lower or higher based entirely on what the stock was doing that day. Once you understand RSUs this way, as future income events, not fixed wealth, you approach every next decision differently. And if you're interested in getting a simple calculator to show you what the taxes will look like when your shares vest, there's a link in the description to go check that out. Most people know RSUs vest over time, but knowing that and planning around it are two very different things. I talk with people all the time who say, Daniel, I've got shares coming in every quarter, but they've never mapped out what actually is coming in, what the income may be, what the tax hit could look like, what the plan to do with the shares after. I call this the vesting to investing gap. People know when the shares vest, but few calculate what those vesting events are going to really cost them. And that's where the problem begins, because your vesting schedule is not an administrative detail. It's an income engine. It determines when income hits, how much, and how unpredictable that number can be from year to year. Every RSU schedule comes down to three moving parts: how many shares vest each time, how often they vest, and how many grants are overlapping all at once. Now that last one, that gets missed pretty consistently because many people receive new grants every year, which means eventually you're not managing just one grant. You're managing multiple grants vesting at the same time. And when those stack, income can ramp up fast. And that's how someone ends up with 6 figures of RSU income on top of their salary and bonus. Not because anything unusual happened, but because nobody stepped back and looked at the full picture. Now, let's talk about vest day, because this is where everything becomes real, and for a lot of people, surprisingly unclear. They see shares show up, and some get sold or withheld for taxes. And that's about where the understanding stops. But 3 things are happening at once. First, income is created instantly. If 250 shares vest at $160, that's $40,000 of W income right then and there. Second, taxes are triggered immediately. Your company withholds shares to help cover taxes. So maybe 70 to 75 shares are withheld and around 175 land in your account. But here's where people get tripped up. You were taxed on the full $40,000 of value that vested, not the shares you keep. Third, and this is the hidden one, you now have an investment decision. Those remaining shares are no longer compensation. They're an investment position. And if you don't actively choose what to do next, you've chosen to hold them, which means you've taken market risk from that point forward. So, in one moment, income is created, taxes are triggered, and an investment decision is made all at once. If you're not prepared ahead of time, default decisions take over, and that's where many of the problems begin. Let's talk about how RSUs are really taxed, because this is where things often go sideways for high earners. Because most people know RSUs are taxed. They just don't fully understand how, when, and where it shows up. At grant, nothing happens from a tax standpoint. No income, no taxable event. But this is where the first mistake often starts. People anchor to the grant value and never build a plan around what may actually vest later. The real tax event happens at vest. Using our example, 250 shares vest at $160. That's $40,000 of W-2 income, and that income gets blended into your salary and bonus. It doesn't sit or go into some separate bucket. It increases total income for the year, which is why many people underestimate both how much they made and how much they may owe. Now here's the next issue. RSUs are withheld at supplemental wage rates, but high earners may owe at much higher marginal rates once total income is considered. And that gap, that doesn't include state taxes. So on a $40,000 vest, withholding may cover part of the bill, but not all of it. If that happens multiple times a year across multiple grants, that shortfall can add up quickly. That's where surprise tax bills come from. Now, if you're still watching up to this point in the video, either you're committed to DIYing your RSUs or you're thinking, okay, I need to understand my actual numbers, which is the right instinct. Go to the link in the description below and book your free 60-minute equity review. I map out your vesting schedule, real tax exposure, and answer the questions you have and the questions you're not thinking about. No products, no pitches, just clarity around your situation. Now, there's one more tax issue to cover, and this one will cost big if it gets missed. It's double taxation. Not because the system is designed that way, but because of how reporting can work. Here's the issue. That $40,000 at vest was already included in your W-2 income. You already paid ordinary income tax on it. That amount becomes your cost basis. Later, when you sell, the brokerage company sends you a 1099-B, and sometimes the basis shows as incomplete or even zero. If that gets imported without adjustment, it can look like you had a much larger gain than you really did, which means you end up paying taxes again on money that was already taxed at vest. The fix is making sure the reported basis matches reality. If you sell at the same price as vest, there may be little or no gain. But if basis is wrong, you create a completely unnecessary tax bill. I've seen this happen even when professionals were involved. Because if nobody is connecting the W-2 income and the brokerage sale report, overpaying becomes pretty easy. So now you understand what RSUs actually are, what happens on vest day, and where the tax surprises usually come from. But understanding RSUs is only half the job. The other half is knowing what to do next. Do you sell or do you hold? How much company stock is too much? How do you actually turn random vesting events into real wealth instead of reoccurring confusion? That's what the next video is about. I'll walk you through the sell versus hold decision, the system to run before every vesting event, and how to turn company stock into a repeatable wealth plan. Click right here and watch that video next.